There is a clause written deep in the fine print of your mortgage that might come to haunt you a few years down the road, and it's called total indebtedness. Now, the truth of this clause is that almost every institution has them written into almost every one of their mortgages, and you aren't special. So it's not like you're going to get the option to ask the bank to remove the total indebtedness clause from your specific contract with them. So you had better understand exactly what it is you have signed, and then also what you can do to make sure you're protected from predatory lending practices like this one. All that and more in today's episode of Reading the Fine Print in Your Death Pledge. Mortgage. But really quick before we begin, please make sure you subscribe to the channel. If you would like to learn more about Canadian real estate, click the like button if you want to keep more money in your pocket and not hand it over to the overlords of the big five banks. And know that if you're looking for real estate help here in my market of Surrey or the Fraser Valley of BC, you can book a call with me right now using the link in the description below at a time that works best for you. And now on to learning more about your mortgage so it doesn't come back later on and bite you in the app. There are many clauses that you might not be aware are in the mortgage that you have signed. They're not necessarily all in there, but they very well could be and very well possibly are when you're agreeing to a new mortgage here in Canada. Like when the banks register your mortgage for the full purchase price rather than the mortgage amount. Or when they insert something called a bona fide sale clause that means you can only break your mortgage by reselling the property at an arm's length transaction, and you can't just go to another bank and refinance. Or in today's case, the total indebtedness clause, which is exactly what it sounds like. You see, this clause ties all of your liabilities that you have with a single institution together. So if you have a mortgage, a car loan, a line of credit, and a credit card with one bank, and maybe you miss a payment, that institution can tie all of your other debts together in recovery of, say, maybe that mortgage. Yeah, that could happen even if you've made all of the other payments on all of those separate accounts. Now, of course, you're going to be like,
"Oh, this will never happen to me. It's not a big deal that I owe all of my money to one institution."
oh yeah? Well, let me tell you a real life story about a recent client of mine and how this single clause not only affected them, but also how the bank misled them, and finally, how it's all legal for the lenders to do so. Now, it started like this. Many years ago, you went into a bank and you got a loan for that sparkly new condo that you saved up for many years in order to buy. And life went on. But during lockdowns, it was obvious that, well, your business started to struggle. So at that point, you went back into the bank and they told you that they weren't willing to help you redo your mortgage, maybe borrow a little bit more money. But what they were willing to do is give you something called an unsecured line of credit. Now, a secure line of credit is tied to the property, but an unsecured line is not. So as a result, you don't end up paying 3, 4, maybe 5% interest like you would on a mortgage or maybe a home equity line, but rather on an unsecured line, you're now paying something like 9, 10, 11% or higher. And as time goes on, unfortunately, your business was not able to recover. Even with that new cash injection, at that point, you just had no other choice. And unfortunately, you had to go bankrupt. Well, if there's equity in your home, and in this case there is, you need some time to sell off your property and help pay off some of your debts, because that's exactly how bankruptcy works. It's not like you just get to walk away. You do have to try and pay some of your debts. It gets really, really obscure. But in many bankruptcies, the client gets some sort of exceptions to their debt to be able to afford, for instance, housing for the future. And also that might apply to something like a car. So if you go bankrupt, you might get an allowance of $4,500 of your home equity to maybe buy a used car. It's not going to get you much of a car these days. And maybe you get something like $12,000 to help arrange your next rental and help put a roof over your kid's head, even though you've gone bankrupt. So what should happen is you should sell your property, let's say in this case for $700,000, and you might be lucky enough after your bankruptcy and everything is done to have $16,500 in your pocket to try and restart your life. Now the bank might take back their $650,000 mortgage, and that new $50,000 that you borrowed on your unsecured line, well, the bank might get some of that back after the realtors are paid in the transaction, the trustees collect their fees, and you get your exemption. The bank might recover some of their money. In other words, the bank's probably going to eat most, if not all, of that unsecured line of credit. But let's stop for a minute and remember way back when you signed that original mortgage, years ago, it contained that total indebtedness clause. And that, in this case, ties your unsecured line of credit to your secured mortgage, meaning that when you do the math, your 16.5 now goes to the bank. Or even worse, the bank forecloses and takes away your power over even selling the property as it tries to mitigate the damages. And before you say,
They can't do that. It's clearly stated on the line of credit that it's unsecured.
don't even go there. Many homeowners have tested this particular clause in court, particularly against credit unions here in BC. And guess what? The judges found that, yes, indeed, that original mortgage document stands and you owe all of that unsecured amount to the bank. Now, luckily, there are a few things you can do about this to avoid some issues. First, I'll let you know that I have a particular set of skills, and I've helped many people short sale their properties in the past, meaning multiple times I have convinced the bank to take a loss and avoid the foreclosure process. Unfortunately, it doesn't put any more money in my client's pocket, but it does help them move on to that next step without an embarrassing, long, and costly foreclosure process. But second, this is the real fix. Never, ever have more than one loan or piece of debt at the same institution. If your mortgage is at Scotiabank, have your Visa with RBC and your car loan at TD. And your investment property mortgage, well, have that somewhere else. Don't get me wrong. I'm not saying to take out loans and don't plan on paying them back. No, what I'm saying is don't put all of your eggs in one basket. And remember this one thing, the bank, they're not your friend. You want to diversify your debts as much as you possibly can to protect yourself more than anything. And if you're having trouble making those payments, call your bank early on and ask for help. Most banks these days have some sort of assistance programs if you're having trouble making your payments, as do mortgage insurers like CMHC and Sagen. And if you've done all this and you're still finding yourself in a really tough spot and you need help selling in Surrey or the Fraser Valley, well, you can book a call with me right now using the link in the description below at a time that works best for you. Thank you so much for subscribing, clicking the like button, and we'll see you in a couple of days.